Hello, everybody. It's Dr. Rick dropping in on you. Hope everybody is having an unbelievable start to your day. Hope that you are doing great in your endeavors during the week. As I always say, even if things aren't going the way that you want them to go, remember, if you're still breathing, you're still in the fight. Never give up, never quit. Recenter yourself, refocus, step back, and understand that there's absolutely no problem that God does not have the answer to. And this isn't a religious presentation. I'm a very spiritual person. I trust and believe in the Most High, but I also understand that there are a bunch of things we have to do in order to take advantage of this unlimited power that's before us, and it's about unleashing the mind and so much more. And we get into all that other stuff today. This is Wealth Building Wednesday. Before I get started, I want to uh, preempt and let you guys know, for those of you who are serious about taking the next step in properly setting yourself up financially, speaking with some experts, being in a mastermind group, but going through a 6-month program. Just by what you're going to hear today, you're going to understand that so much you don't know about the things you think you know because of how it's been presented to you, and you automatically trust it. That's costing you literally every month, and you don't know it. Just by joining this group, you're going to save so much. You're also going to learn how to develop and build and grow. We've had a great start to this series, and we will continue to go. And I want you to be a part of it. So some years ago, I created an organization called Legacy Wealth. Legacy Wealth is an organization that's built around the education surrounding finance, money, currency. And there's a difference between money and currency. And we get into that over and over and over again, because it's going to be so important that you understand the difference between money and currency, because the challenge with currency right now is going to be something we all need to be paying attention to. But anyway, by joining, you're going to get a 6-month course that's going to educate you on everything from 401k plans to the basics in understanding stock markets, why real estate is so important, how to hedge and leverage your income, and so much more. It's about new revenue streams. It's about there's a saying in the financial world: it's not how much you make, it's how much you keep. It's not what you're able to produce solely. You got a bunch of people who, when they leave their jobs, will within a short period of time not have anything, no matter what they've made, because of improper management. The Legacy Wealth Program is there for you if you want to take it now. It's not just the 6-month program. It also comes with a lifetime membership to the Epic Realm community, a mastermind group where we come together, we encourage one another, we put our minds together to help people get what they need, whether it's funding, whether it's for a business, whether it's working out, scaling, whether it's working out, anything that has to do with growing yourself. We're in this place and we're making it happen, and you get a lifetime membership as well. But anyway, Legacy Wealth is something that I think, if it's not Legacy Wealth, find a place where you plug in the people who are talking money. If you're not around people who are talking money at least once a week, twice a week, then you need to find people who are, because the understanding of those that comes with those conversations, the questions that are presented in those conversations demand answers. And even if the answer isn't found in the conversation, it puts the question to your mind and it allows you to go out and find the answer. Trust me, the answer exists. So we're going to talk about money power principles today. One of the most important money power principles is you get what you tolerate. And I'm going to use specifically the 401k plan to make my point. This isn't going to be long, but I promise you, if you stick around, it's going to be powerful. Okay. First thing you have to think about when you think about the 401k is it's only a few decades old. So we're talking 30 years to gain an understanding of what this mechanism is going to look like. One of the biggest myths that float around and a lot of people think is my 401k is what I'm going to use to retire with. Your investments in your 401k would have to perform so astronomically well for you to retire on it and live another 20 years after retiring. And most people are living 20 and 30 years after retirement. It would have to perform astronomically off the charts, supernaturally, in order for that to happen. Here's why. Let's say the average contribution is 3% of your income, and your employer is doing matching contributions. That would be one of the benefits to participating in a 401k is matching contributions. Okay, now that's 3% plus another. So you're looking at 6% of what your income is. What's going to perform at a level that's going to over a 30 year period? And this is you starting a 401k and keeping it going for 30 years. Okay, you're going to invest 6% in, and it's going to produce your 100% income so that you can continue to live like you've lived after you retire. It's not going to happen. It should never have been presented as the end all be all to retirement. It is one mechanism that when used properly can happen. And yeah, there are reasons why. One of the reasons why, again, is you got your employer with matching contributions. So they're matching whatever you put in. Hey, somebody's matching me on what I contribute and invest. I'll take that as long as I can manage what I'm investing in. And here's the thing. When I did a segment a few weeks ago, one of the things I talked about is experienced investors understand the risk. They understand what they stand to lose. They also understand their potential cost of the investment. And most people don't consider that. Your cost of your investment is how much you're going to pay in taxes and how much you're going to pay in fees. And both of those are very, very difficult to understand. The average person cannot understand it. If you ever seen a 401k statement, you know what I'm talking about. But here's the thing. When you start talking about taxes, one of the things that is real big with 401ks is it's a deferred taxing. It's deferred taxation. In other words, I get to make a tax deductible contribution to my 401k. So that money isn't taxed, but it's going to be taxed on the back end. It sounds great, right? The problem is no one knows what the tax rate is going to be when you draw that money out. It's under the assumption that the tax rate is going to remain the same. And we know that's definitely not normally the case. So you're looking at, okay, I'm deferring on this. Here's another problem with deferring. You're deferring on a currency asset, so to speak. You're deferring on a dollar amount. The problem is, how much is the dollar itself growing? It's not, it's depreciating. The value of the dollar is depreciating. So I've got $100 sitting in here. And if it's not working hard enough for me, it's not creating a growth enough, it will actually shrink. That's why money under the mattress is no longer a savings option. Why? Because the currency under that mattress isn't worth it what it was 10 years ago. 15, 20, 30 years ago, the dollar is depreciating. So then that is also something you have to look at when you're investing in your 401k is how much will the currency depreciate? How solid is the dollar? And so you have to calculate that in when you're trying to predict growth over long term. But here's the big thing. And the reason why I brought up the you get what you tolerate thing as a money power principle, because you do. And I'm going to explain that in a second. But here's the thing. A big part of the cost of operating and contributing to a 401k are the fees. And the program managers are charging astronomical fees. And the Department of Labor does a periodical audit of these 401ks. And what I can tell you is the last audit produced a situation where 75% of the companies that were audited were penalized and fined for errors and cost, and in many instances made to reimburse clients. But how much are they not getting caught on between these audits? How much are we talking about being lost? Well, we can sit up and say, about 6 years ago, they did an audit of and projection and study on 401ks and determined that about $17 billion a year is the fees and costs that are being charged to hardworking citizens to contribute and participate in the 401k. And so now you're talking about the cost. And when I talked to you a few weeks ago, I told you that seasoned investors, when they go in, there are 4 rules. Instead of worrying about how much they're going to make, they worry about how much they stand to lose. It's more important on them to manage losses than it is to produce gains. And that's something that has to be in the mindset and the mentality. Number 2, asymmetric risk reward. What is that? That means that while most people are being told you got to have a lot of money to invest to make a little money, you're going to get maybe 10% on your return, whatever. They're looking for asymmetric risk reward. In other words, they want to invest a little and get a lot. So they're looking for high potential ROIs, return on investments. And so they're trying to invest low and reap high. And so they sit around and they wait for these deals to come forth. So again, what happens when you diversify like that and you're investing across assets and then you're having an asymmetric philosophy where your asymmetric risk return is saying, I'm investing a little to get a lot. What happens is you can lose in some of those assets and still win big. Why? Because your investments are low, your returns are high. So the wins in other assets will cover the losses. That's what you call hedging. And that's why diversity is so important. But when you talk about a situation with your 401k, you're investing in something and the fees are astronomical. Now, I'm not saying don't do it because there are some benefits to do it, but it definitely cannot be your only means of retirement. Number one, you need a very solid and diversified portfolio that you can build over time that has assets across industries. You want something that if something goes wrong in this industry, you're not sunk. Why? Because you're investing across industries. You're also investing in assets that appreciate. What you'll find with the wealthy is that they use insurance as a powerful mechanism to increase their wealth and to protect their assets. What I mean by that, and I think I shared this the last week. Trading Places, Eddie Murphy, right? He's a bum on the street. The 2 billionaire brothers have this argument about environment. One believes that you're either born with it or not. The other one believes that you can take anybody, put them in the right environment, and they'll succeed. So they have this bet, and they kidnap him, and they put him in this life, and he wakes up, and he's in this mansion. And, he freaks out, but then they tell him, hey, all this is yours. Because he's starting to stuff in there because he's looking at all this expensive stuff. He's starting to stuff it in his jacket. Say, you don't have to take anything. It's yours. You don't have to steal it. It's yours. He says, so everything in here is mine. And they're like, yeah. So he picks up this vase and he throws it down and breaks it on the floor. And one of the brothers goes, that we paid that was a $50,000 vase. And the other brother goes, that's okay. We paid 50 for it, but we insured it for 70. This is why wealthy people have collections, art collections, jewelry collections, car collections. You think it's about exorbitant lifestyles. It's where they hide their wealth. Number one is it's in something that holds value or appreciates in value. And it's insured more likely for more than what they paid for it. They get it at a price, a negotiated price or whatever, and then they insure it for what they can get it appraised for. And that's the increase in, so they can literally increase their wealth by a purchase. See where I'm going with this? We're in the opposite, where the average person is decreasing their wealth by a purchase because they're buying something that immediately depreciates in value. So they spent more for it than what it's worth. In for instance, in a car, before you even get it off the lot, once you buy it and it's in your name, it's not worth what you just paid for it unless you negotiated a real super deal on it, and that's possible. But in essence, it's still going to continue to depreciate in value. As you use it, it's not going to appreciate. unless you create a situation where you invest in it and you don't drive it and you turn it into a collection car, and over time you add things to it, make it special, and then all of a sudden it does increase in value. Now it's an investment, but just having a car that you drive, no, it is a liability, like so many other things that we spend money on. But that's the difference. They are actually sitting up using insurance as a powerful mechanism. And that's the thing. We have to learn all of these things that are going on. That's what the legacy wealth thing is about. It's about learning what's out there and understanding that it's not just for the extremely wealthy. Anybody can practice it. You're just going to practice it at a smaller scale. You're going to take time, you're going to build, and it's about time and patience. One of the things that we don't have enough of is we're looking for the quick thing, and then when it doesn't work, and normally when you look for the quick strike or the get rich quick thing and it doesn't work, it normally hits you and hurts you hard, and it creates this pain aversion. And so now you don't even want to try it anymore because you tried to get out there and go hard and fast and got took or just had a bad day, because investments come with risks. You're not going to win every time, but you got to sit up and play the game in a way that you can absorb the losses and continue to go. Okay, so again, here we are. You get what you tolerate. What do I mean by that? I mean, you have to know what to expect. You have to know what you have a right to demand. Most people don't have a clue about what they can demand of their 401k plan managers. They don't know what they can demand of their employer. They don't know how to look at a statement and say, okay, this is how much I'm being charged in fees, because it's so convoluted and it's so set up to where you're not supposed to be able to calculate the fees. They're supposed to be hidden, but not hidden. Now, the new laws that came about said that it had to be a more fiduciary process. So they put everything in there, but they made it page, I think like the average page statement page that explains fee schedules and all that stuff is like 50 pages. Who's actually reading that? And if you get through it, who's actually understanding that? And that's the thing. But you get what you tolerate. So there may be a situation if you're going to play the 401k game, that you get someone who is capable of reading it and has a fiduciary responsibility, meaning that their responsibility is to make sure that you win, not to win off of you. So they're not going to be commission, they're not going to be commission driven. They're going to be results driven. And so you want someone who is results driven, meaning they win when you win. And you want them to look at it and say, okay, is this good or not? You're going to have to get to a point where you start investing in yourself. Trying to manage something that you are naive in is how you get taken. And everybody was just thrown this thing. Hey, the 401k is the best thing since sliced bread. The truth of the matter is, when properly used, it's a good tool, but it's definitely not the only tool, and it should never be viewed as that. And you can only win in it if you are really, truly paying attention to what's going on. Because you remember, you're in a volatile market. This is investing. This is a way, this was presented and sold to the American public as a way of owning a piece of the capitalism pie. It's a way of owning a piece of Fortune 500 companies, and getting in, and it's all good. That's something that you should want to do. You should want to leverage public trading. But you should also be aware of things like precious metals, jewels, art. What else? I know I'm missing something, but definitely real estate. If you have enough, venture, get into the venture capital realm. But you have to learn how to understand business plans and projections, and be able to predict how well you think a company is going to do before you get into it. But there are all these places that you can get into, and you don't have to have it all at once. You can get started in this game with $10. Go out and buy your first stock. What that's going to do is expose you to a world that you haven't been exposed to if you don't. And then you start to learn about it. You lose $10, okay, you put another 10 in until you learn. And what you'll start to do is learn, okay, number one is I got to make sure I choose a good company. I am not big on active trading, especially hyperactive trading. Day trading is not something I'm into. Buying and selling, buying and selling. People get rich doing it, but people go broke doing it too. I'm into finding solid companies that have produced over years and shown that they can survive downturns in the market, because this is where most people fail. Most people get into the market, as long as it's going up, they're great. When it starts to go down, they get concerned. When it starts to go down significantly, they get frightened. And what happens is most people panic and sell. I tell people all the time, you haven't experienced a real loss until you sell. Until you finalize that transaction, it's still your stock. It's still a chance that the stock can recover. If you've done your homework and then you know the market is going to have downturns, that the market will recover. The market is going to reflect the reality of economies around the world. And so it's going to sometime have inflated prices where it needs to correct itself. And sometimes it's going to have deflated prices where it needs to correct itself. And it's going to return to where it should be. So when you find companies that report accurately and well and have done well over time, they're going to recover, generally speaking. Every now and then you get a big company that sits up and says go. But if you look, the Fortune 500, those top several hundreds, they've been there forever. Why? Because they went. Well, that's the thing that you got to understand. You got to understand that you control your financial destiny, and that it's going to take time to get it under control, but you have to start. The one thing you can't do, the one thing you can't afford is not to start. Theodore Johnson, you've heard me tell this story, worked at UPS, never made more than $14,000 a year. And his financial mentor was telling him, look, you're going to have to take 20% of your income. Now, look, he's telling him 20%. Your 401k, 3%. You think about this. He said, you're going to take 20% of your income. He didn't say disposable income or discretionary income. He said 20% of your income, 20% of your gross income, you need to take and invest. And he told him what to invest in. And he said, I don't have 20 to invest. I just make this. I just told y'all I make it. He said, the less you make, the more important it is for you to invest in something that expands your earning. One of the ways that you give yourself a raise is to invest in something that pays you back. Make your money work for you. And it can happen in small amounts. You got to start somewhere. If you take something and say, okay, I'm gonna take this $5 and put it here, and this $5 gives you 50 cents. For the next 10 weeks, it gives you 50 cents. You just made 100% profit. Now you can scale that. It's $5, $10, $100. It's the same principle. But you start somewhere. Better than having the $5 sit in your pocket or go spend it on something you don't really need. Invest it in something that can grow over time, and you'll look up one day and a lot of the strains and stresses that you're having now you won't have, but you've got to start. And the thing is, you can get so caught up in your moment that you don't fix anything. I'm just trying to get people to see beyond the moment, get out there and get started. So whatever you tolerate, you're going to get whatever you tolerate. If you tolerate these programs with these exorbitant fees, think $17 billion a year in fees. You know, I've been doing some research on certain retail industries just for the sake of the community. And $17 billion in fees is more than the entire beauty supply industry. It's a $15 billion a year industry. 17 billion is topping an entire retail industry. In product, they're generating revenue from product. This is just fees. This is what you're being charged to put your money in something and invest something. Also, that same thing applies to other things, like when you're working with a financial advisor, financial manager, whatever. You need to know what your fees are. What are they going to charge you? What their commissions are? All this stuff. How are they paid? Their commissions? What percentage? And all this stuff needs to be real clear to you. You've got to start looking at every dime, every cent as if it matters. And you've got to sit up and stop making knee-jerk moves and decisions and start to understand things and take it slow. I've taken some major blows moving too fast. thinking because I see the numbers that it's okay to spend it or okay to do this with it. Slow down. Make sure the decisions you're making are the right ones because they carry long-reaching consequences. It's like a chain reaction, and you want to be as in control of that reaction as you possibly can. Nobody's perfect. Nobody's going to get it right every time. It's a process, but I guarantee you, you need to put your head into something to learn. Again, I encourage you to join Legacy Wealth. For less than $1,000, you're going to get a 6-month course that's going to give you all this I've been talking about and a whole lot more so that you have the basis and the foundation and the understanding to really engage your future financially. But you're also going to be a part, a lifetime member of a group where people are really getting on. The people in this group, a lot of them have my former clients. They've worked with me. But these people are CEOs, financial advisors, one doctor, one nurse practitioner, some other type of business owners. It's a growing group. It's a lot more than people than what I named, but it's a lot in there. And it's a place where you can come have your flames and your passions fanned, but it's also a strategic spot where you sit down and you come and you sit down and say, look, this is what I'm trying to do. Anybody got any ideas? And the brainchild and the mastermind, they come forth and they sit up and say, hey, let's try this. Have you tried this? And you get down. You also find that you're going to find some people you click with and you can start reconstructing your circle. And with today's technology, it doesn't matter where they're at because you can have instant access to them anytime you want to. This is an opportunity. Look, the link is in the description box. Definitely start making connections with the right people. This is an opportunity to do that on a grand scale. Again, the money you're going to spend on this course and in this membership and everything, you're going to save, I guarantee you, just in fees and cost and spending mistakes and so many other things, not to mention what you stand to gain when you learn how to properly move and handle what you're earning. On that note, that's going to be it for the day. As I always say, I live my life on full so that when I leave this place, I die on E. I challenge you to do the same thing. Don't feel stuck. Feel inspired. Make a commitment. It is in the moment of your decisions that your destiny is shaped. Look, you're going to have to be committed to changing the things around you. They're not going to change by happenstance. It's not going to come easily. You're going to have to work for it. On that note, look, I'm out of here. I'm wishing you the best. Let's take a journey.